Mr. Krishan Sharma from HDFC. Mr. Krishan is the Deputy Vice President and National Lead Training at HDFC Asset Management Company. He's a graduate in Economic Honors, PG in Management Accounting. He's been in the mutual fund industry for the past 26 years. He's very popular trainer. He's been training all over, and for 26 years, he's become one of the most popular trainers in the financial industry. Before joining HDFC Asset Management Company, he's worked in various positions in research, portfolio management services, and institutional business. He's taken a huge number of sessions. He's trained a lot of people, and we somewhere felt that for taking on the next session, which is this no-pain solution could be a win-win bet, which is primarily about hybrid funds. He's the he's the automatic choice. Mr. Krishan, nice to have you here. Can you please put on your video? Yeah.
Yeah. Namaskar, Colonel Govila. How do you do?
Namaskar, and we are all waiting for you. I've already introduced you. I've built up the expectations, and
thank you.
We are raring to go.
That's very scary. Whenever you have to have expectation to meet, that becomes scary. Whether you're a parent or whether you're an investor, right?
But looking at your various videos available on YouTube, it doesn't seem so at all.
So at the outset, sir, thank you very much for this opportunity. And I'm talking to the veterans of armed forces and those who are serving also and their families. First of all, I salute them, right? The way they save our nation on borders. And let me take the liberty from this, that since I'm addressing to the people from armed forces, friends, no one in our society understands towards strategic and tactics better than you, right? We have our armed forces, that strategy. How much forces we should have, what kind of weaponry we should have, where our command should be, where our units should be, where our barracks should be. All this infrastructure, everything, the way we manage our defense forces is strategy. But recently, last year, we had some problem on borders on the both sides, and we moved our troops. What our troops there in the Himalayas, how they are being managed, what kind of weaponry they have carried with them, what kind of weapons they will use, how they will save the borders of the nation. For a short decision, that's called tactics. Similarly, in investments also, you have to follow these two words, friends, strategy and tactics. Strategy is something, the overall objective of your investing, what you want to achieve from your investing. And if one is not clear what they want to achieve from their investing becomes a futile exercise. It becomes a bhagya pradhan rather than the karma pradhan, right? So we have to ensure that come what may, at the end of the investing journey, I ensure that I'm a successful investor and meet all my financial objectives, and I create wealth for me and myself and my family. That's what the entire investment process is. But the sad part is, Colonel Govila, is although I don't have data from India, but I have data from US. There's a firm called Dalbar Associates, and the firm is working for the last almost 15, 17 years there. The first study they did for US for the period 1985 to 2005, that is 20 long years. And in those 20 long years, what they observed is that average American investors have earned less than what the markets generated returns, right? That's the very sad story of a common investor. World over, not only in India, any country, any society, this holds true, that the average return earned by investors are far less than the returns generated by the markets, generated by the mutual funds, generated by investment products. Why it happens? There is some problem with our behavior, right? Investing is not an endeavor of IQ, friends. It doesn't need knowledge beyond a limit. It doesn't need a good IQ, but it needs a lot of character. That is something we'll try to understand that. I've been given a topic to talk on dynamic asset allocation. Let me submit at the outset with whatever NFT I have at my disposal, friends. No product is good and bad. No strategy is good and bad. No investment is good and bad. No asset is good and bad. No, they are just appropriate to your needs. So whatever is suitable to you, whatever appropriate to you, need to be deployed when you do investments. What does it mean? It's a solution, nothing else. Colonel Saab, I'll take the help from presentation. Some few slides I want to show. So is it visible? I've shared it.
Yeah, it's coming on. Yes, it is visible in edit mode. You'll have to get on to the presentation mode. Yeah, it is very much
Great,
visible.
thank you. Friends, investing journey is a long journey. Please never look at investments in bits and pieces, right? It's a game which you play again and again. It's a game which you play every month, every year, every quarter, year on a year. You keep playing this game, right? So this is a journey, and journey needs to be peaceful. We are Indians, and we have a great Indian philosophy which says that there is a relation between prosperity and peace. The human life in older Indian days were divided into 14 samskaras, 16 samskaras. Every human being in India used to observe 16 samskaras, and all these samskaras were celebrated at utsavs, right? And somewhere in our life, these 16 samskaras or 16 utsavs of any human life represent the prosperity and wealth they have created in the journey of their life, right? And it says that whenever any sanskar we observe, whenever we do yagyas on these sanskaras, yagya never starts without something called Shanti Path or Shanti Mantra. In Shanti Mantra, you have seen that the Shanti word is repeated thrice. And the 3 times, why it is repeated 3 times? It represents that your body should be in peace, your mind should be in peace, your spirit should be in peace. Similarly, it means that your past should be in peace, your present should be in peace, and in future should be in peace. If peace is not there, lasting prosperity will not happen. And same goes well with investments. What is true for life, friends, that's true for investments. If an investor is not peaceful with himself, if investor's body, mind, and spirit is not peaceful, if investor's past, present, and future thinking is not peaceful, he will not be able to take right decisions. And what makes you peaceful, friends? Very simple to understand 2 different words, and these are short term and long term. Long term depends on short term. What is a long term? Long term is nothing but the sum total of several short term. It means that if somebody say you that in equities in 10 years you'll be able to earn 12%, but for that you have to survive for 10 years. Before 10 years, there'll be 5 years. Before 5 years, there'll be 1 year. Before 1 year, there'll be 1 month. Before 1 month, there will be a week. Before week, there is a day. And before day, there is an hour. And before hour, there's a minute and then a second. If you're not peaceful in a second, you will not be able to reach 10 years. So you have to protect your short term. And when you protect your short term, you cannot do it with equities. You have to take the help of other assets. And this is what investing is, friends. So what you need to do, very simple. Before I come to the concept of dynamic, we need to understand why dynamic asset allocation. What solution does it give it to us, right? So what you need in investing journey that keeps you peaceful at any given point of time in your entire investing career, friends, investing journey, friends, you should observe safety in your investments. You should have ample liquidity in your investment. You should have adequate return that meets your goals and objectives in your investments. And you should be able to enjoy it as best as possible, this tax efficiency. No single asset can give you all. So what you have to do, you have to allocate your assets accordingly. You always want good health. For good health, you want carbohydrates, you want fat, you want minerals, you want antioxidants, you want roughage. Is there any single food in the world that gives you? No. So what you do, you have a thali. In thali, you have everything, right? That roti and chawal gives you carbohydrates. The vegetables gives you roughage and the minerals. The fruits gives you antioxidants. The ghee gives you fat. And this is how you form your thali and maintain your health. Similarly, there is no single asset which can offer you always safety, liquidity, return, and taxation. Balancing between these 4 needs is called investing, friends. And you need asset allocation. Well, sir, I'm going a little rushing up because you will find that words per minute is a little higher compared to the normal, right? I really apologize for that. Now, look at, friends, what we need to understand before I come to the dynamic asset allocation. The assumption is that markets are always volatile. Bulls and bears are the inseparable parts of the markets. The kind of fall which we have seen in 2020, that is 30% fall within 7 days, in a short span of time, in 7 days, 30% fall. This is not the last fall of our life, and will not be this is not the first fall of our life, and will not remain the last fall of our life. But the thing is, when we know that bulls and bears are inseparable part of the markets, market can fall 50% for any given year. If we know this, then why we worry when the markets fall? We worry because we are not at peace. And you know why we are not at peace? Because we have not done asset allocation. So if you do right asset allocation, seek the help of your advisor, they will be able to find out what's the right asset allocation for you. Now comes, if you have to do asset allocation, why asset allocation is important? This is the reason we need to understand. Number one, we should have peace in our investments. Number two, why you should have. Friends, whatever I'm going to say, most of you will not like it. Even then, at the cost of your annoyance, I'm saying this, friends, we are not Arjuns, we are Duryodhanas. You know what? Well, once Duryodhana tried to arrest Lord Krishna, when Lord Krishna took the offer of Yudhishthira, Tukar was that if you give us 5 villages, we won't fight. At that point of time, Duryodhana ordered his soldiers to arrest Lord Krishna. Duryodhana was not knowing that Krishna is Narayana. At that point of time, Krishna showed him who Krishna is, and he showed him his Virat Roop. He's the only second person after Arjuna who could see the Virat Roop of Krishna. The moment he came to know that he is Narayana, he fell on his feet and seek forgiveness. And he said to Krishna, please pity on me. I know what is adharma. I know what is dharma. I know what is right. I know what is wrong. But the problem with me, even after knowing what is right, I'm not able to do right. Can you resonate with Duryodhana, friends? This is what we are, right? Each one of us want good health. And each of us, we know that going for a morning walk is a good thing. And we can attain good health by going for the morning walk. Only 1% population go for the morning walk. What is evidence? Evidence is go tomorrow for a morning walk, you will find no, but not many people. If everyone will come for the morning walk, the parks and roads will be crowded. So after knowing is not important in investing. That I know what is right and how to do right investment is not important. Are you practicing the right investment practices? That's important. So are we doing it? This is in the picture in front of you. Look at this. The black curve shows the returns generated by markets for the last 15 years. And the red curve shows the investments done by Indian investors in the last 15 years. Do you observe anything? Whenever the markets have given higher return, just a year before, our investments we were rather taking funds out from the markets. And whenever the returns were low, next year, that year, we were investing, net sales were positive. We have always invested when the markets are rising. We have never invested when the markets are falling. And each one of us know when to invest in markets. We should invest when the valuations are cheap. We should invest when the markets are falling. We should rebalance our investing when the markets are at peak. We should readjust our investing when the markets are rising. Have we done that? No, we have not done that. Picture is in the front of you. And look at the 3 circles particularly. All 3 circles, when they were the periods of best returns generated by Indian markets, those are the periods when we have withdrawn amount from the markets. Problem is very simple, friends. Markets are volatile. This is the first assumption I told you. There are ups and downs in markets, there are peaks and troughs in markets. But what happens to your sentiment? You have to observe a sentiment of a sannyasi. Come what may, sukh aur dukh mein ek jaisa mera vichar rehta hai. Right? Do we carry such kind of a temperament? No. Our sentiment goes up with the market. Our sentiment comes down with the market. What you need to do to become a successful investor, that your sentiment should remain same in any kind of situations given to you. It should not move with the market's ups and downs. The moment you will be able to do this, you will be able to generate returns, which is more than the market's generated returns. How to get that sannyasi's temperament? Bazaar mein kuch bhi ho jaye, mujhe dikkat nahi aayegi. How to learn that? To accept that markets keeps on rising and falling. But we are not able to do it. When you're not able to do it something, what you need to do? Very simple, friends. I'll come to the behavioral part of it and how to address that. Addressing this behavior is the solution in the form of dynamic asset allocation. Look at the markets for the last almost 40 years. Look at a yearly return. Sometimes the markets have given you returns that is upwards of 250%, and sometimes the markets have given you returns of close to minus 50% in a given year. That kind of volatility for a market which has given you 14% return for the last 40 years, 15% return for the last 50 years. The average return is 15 years, but if you look at the annual returns, they are sometimes 250%, sometimes minus 50%. Most don't survive that kind of volatility in onslaught. you have to protect the short term to reach from this point of 79 to 50,000 of 2021. And that's the answer is asset allocation. Allocating less in equities when the market's valuation appears expensive and more when the market's valuations appears cheap. This is our knowledge, but we are not able to do it. And dynamic asset allocation is exactly a solution which helps you to exactly do the same thing to generate good returns. The very sad part of this story, friends, due to this very high volatility of the markets in last 25 years, only two-thirds of investments have completed 3 years. Only two-thirds. It means that one-third of investments have withdrawn from the markets before the 1 year, and only 5%, only 5%, 5 years, two-thirds have completed, and only 2% investors have completed 10 years of continuous investing in markets. Only 2% investors in India has created the wealth which you see on charts. Only 2%. 90% of people have exited from the markets before that time. We have not done that. So how to do this? Very simple, friends. What the solution is, and the solution, and this is reason number one. Reason number two, asset allocation supports you to generate higher returns. Look at this chart. Again, this is a movement of Sensex for the last almost 20 years, more than 20 years, 2.5 years. There was a period when December 2007 markets were at 20,287, and there was a period this market remained below 20,000 till next 3 years, till next 5 years, till November, October 2013. Full long 5 years. 5 years of anxiety, 5 years of boredom, 5 years of confusion. Market moved nowhere. So had you invested in your equity fund, chances are when the market had a fall of 50%, 50% of people have stopped their SIPs. I remember those figures. That point of time, I was working in industry. Between 2011 and 2013, 50% SIPs were closed, friend. So when the markets have these kind of movements, we stop investing. And we will stop investing, we don't create wealth. But those who remained with one lump sum investment, 100% equity investment, after 5 years, their investment remained at the same amount. But if you have invested with the asset allocation, wherein you will buy more when the markets fall and you will buy less when the markets will rise, you must have made money, right? So what dynamic asset allocation does for you? It offers you 5 or 6 solutions. Number one, it protects you from the downside risk. It enjoys you to exploit the upside risk. It generates additional returns from the volatility. It makes the timing meaningless, and it makes you to price the market at the right price. Although not every time, but in totality, when you will come with the rupee cost averaging kind of a concept, you will see that mostly it will help you to get the right price for investment. And of course, the timing, as I told you, becomes meaningless. So why we need dynamic asset allocation? The third reason, very interesting reason, very important reason, friends. Humans inherently are lazy. They're hardware. We are lazy. We are not made to work. We conserve calories. You know why it happens? See, my weight is 70 kg and my brain weighs only 2 kg. The 2 kg of my brain consumes 28% of calories I generate from my food intake. 2 kg of brain consumes 28% of calories. It means what? Brain is a very fuel inefficient organ. But brain is an intelligent organ. Brain is a thinking organ. Brain is the organ which makes strategies, right? So what, brain has decided why to unnecessarily use brain. The more you will use brain, the more calories you have to consume. So usually brain refuses to function, and it is normally functions below subconscious level, below your consciousness. And when your brain works below consciousness, that's called instinctive hardwired behavior. And due to that, we are not able to take right decisions on right time. So what our brain needs? Our brain needs automation. What is automation? Automation is that when the markets fall from December 2007, when it fell to almost 8,000 by 2009, at that point of time, I should not decide to invest more. It should happen automatically. If you do that, you'll be able to do investments. If you leave it to your decision making, mostly we will fail. So what humans need? Humans need automation, and that's why we have done so many discoveries and inventions, friends. Right? Secondly, again the behavioral part of it. By nature, humans are consumers; they're not investors. Right? What does it mean? Assume that you want to buy a car. And you want to buy a car in the month of this current month of July, and you have a friend who works in a car showroom, and he says that the car which you have chosen for yourself costs rupees 10 lakhs, and you share this information with your friend. I want to buy a car this month, and your friend says this, that there was a festival season coming and next month by August. Why don't you wait till Ganesh Chaturthi? I'm sure that by Ganesh Chaturthi you will get some discount, and the car which costs today at 10 lakhs you will be able to buy at 9 lakh 70,000 or 9 lakh 50,000. What you will do? You will defer your consumption. You will wait. You will wait for the price to fall, right? You will defer your consumption. But at the same time, the other scenario, you share this information with your friend that I want to buy a car this month, and he gives you a piece of information. There is a lockdown for the last 1.5 years. Now the vaccination has increased. Corona is on a retreat, and market strongly believes that by month of August, there will be more mobility and people will come out of ISIS. There is a pent-up demand, and due to pent-up demand, production was less. The car will become expensive because there will be more demand on festival season, and the car which you are buying, which you want to buy at 10 lakhs of rupees, will be 10 lakh 50,000, 11 lakhs. Steel prices have become expensive. Car will cost 10 lakh 50,000. The moment you will come to know that the prices will be higher in the future, the thing which you will do next month, you will start buying today. So price movements impacts our decision-making process, right? This is called the consumer behavior. So what happens, friend? This is called inflationary expectation. What you think about prices in future? In future, they are going to rise, or in future, they are going to fall. So in falling markets, what's happened? In falling market, your brain, since your brain is an apophonic nature, what is apophonic nature? It's try to ascertain the patterns. And once the brain believes that it can pick up the pattern, it behaves accordingly. So in falling market, what does the brain compels you to do? It compels you to defer your investments, and you wait for the markets to fall further so that you can buy at a cheaper levels. So if you have a price expectation that prices are going to fall in future, you will not buy. Whereas if you have expectation that prices will rise in the future, you will be FOMO, fear of missing out, and you will start buying. 1 crore Demat account has been opened in last 1 year by CDSL. Look at when the markets are rising. 99, I'm from mutual funds, friends. Without any hesitation, I tell you something. Whoever investors are there in mutual funds today, 80% of those investors have joined mutual funds in 1992, 2000, 2008, and 2017. Why these 4 years are important? Because these 4 years are important because they were the rising markets. So exactly, we do the opposites. We are Duryodhanas. Right? So how to get that appropriate behavior? Dynamic asset allocation helps you out. Not only it regulates your behavior, not only it compels you to buy when equities are more, when equities are cheaper, and less when the equities are expensive. It also rewards you to balance between the risk and return. Sorry, it is K. I don't know. K has come down due to resolution. It's a risk RAS K. K is down. You can see that, right? So risk you manage by putting some money in debt, and return you manage by putting the money in equities. And the continuous rebalancing of this due to an opportunity given by volatility, dynamic asset allocation funds, friends, can generate returns for you compared to pure equity funds, which are less volatile. We call it risk-adjusted return. So standard deviation is a measure of risk. The standard deviation of dynamic asset allocation funds are always less than the standard deviation of pure equity funds. And here, the most important reason that why you should look at the asset allocation and why dynamic asset allocation, 2 reasons I will give you. First, asset allocation. There was a study by Gary Princeton and Radolph Hood and Gilbert Behaviour. They did studies about the pension funds of US way back in 1977 to 87, 11 long years. and they have observed 94 funds of US, 94 funds of US. They tracked their performance for 11 years from 1977 to 1987. And what they observed that the bulk of returns generated by fund managers of these funds are not due to the stock picking ability, is not due to the timing. It is due to how much money they have kept in debt, how much money they have kept in equities. They have not seen equity mutual funds. They have researched pension funds. Why pension funds? Because pension funds by nature, by rule, by practice is always follows the practice of asset allocation, right? So what they observe that 91.5% returns what you will generate in your life at the end of your investing journey does not depend on which fund you have selected, does not depend on when you have selected the fund, does not depend on when you have invested in the fund. It depends on what kind of balance you have kept between the funds from bonds, funds from gold, and funds from equities. But then after this study, there another gentleman, he came with a wonderful concept, and he says that circumstances of investors and circumstances of economy keep on changing. So you cannot follow a static asset allocation. That's allocation should always be dynamic. It means that in year 2020, you have decided you will keep 70% in equities and 30% you will keep in debt. The person says that it should keep on changing year on year as the circumstances changes. So sometimes your debt contribution can increase to 50%, your equity contribution can fall to 50%. Sometimes it's 70-30 can become 30-70. So you become dynamic in your asset allocation as the circumstances changes, as the market valuation changes, as the economic conditions changes, and that kind of asset allocation is called dynamic asset allocation. And research says that the risk-adjusted return of dynamic asset allocation will be far superior compared to the static or the fixed asset allocation. So what at the end, before I conclude, friends, four important things we need to understand. Number one, if you read about the origin of species, that famous book by Charles Darwin, it says that in the evolution of human being, evolution of any species, be it animals, human beings, anyone, who have survived for the last lakhs of years and crores of years. The only creature which adapts to the changing environment, could survive. So adaptation is the most important thing. How you adapt your allocation in a changing environment, in changing market conditions, that ensures that you survive throughout your journey. And that's why dynamic asset allocation. Dynamic asset allocation will control our emotions. Dynamic asset allocation does not need, as I told you, it's automation. It's automated. You don't have to take decisions on a quarter-on-quarter basis or annual basis. And one very interesting thing I'll tell you, friends, and this is something we need to understand. If you will do it on your own, you will not be able to do it, because human beings have to do so many things. I'll share one very bad experience of my life with you. It was way back in 2006 or 7. My kid was in second standard, 7-year kid. He used to go, school bus used to come pick him up and drop to the home. That day, what happens that me and only my kid were there, and my wife was gone to her place, to some other city. I stay in Jodhpur and she was in Jaipur. Morning, the bus came and picked up my child to the school. At 11 o'clock in the day, I received a call from my wife, because my wife's phone number was there with the school. And my wife told me that suddenly there is a strike by the bus drivers, and the bus driver will not come to drop the kid to the home. You have to go at 2:30 to the school and pick the kid, right? I said, yes, I'll do that. Now, 7-year-old kid. A very bad experience, friends. At 2 o'clock, you know what happened? 1:45 or 2 o'clock, what happened? I received a call from head of the department. It was a very serious matter, and he wanted some data from me. I started working on data, and by 4:30 only, I could recall back that I have to pick my kid from the school. My kid was sitting in the school for 2 hours. I was not picking 4 hours in between these 2 hours. You know why this happened? It happens due to the limited capacity of mind. Wealth of information creates poverty of attention. The brain gives priority to the latest information, and brain does not think about the older information. And this is the reason that we keep on changing our investing ideas, friends, right? You don't need information to become good investors. You need attention to become good investors. So what does dynamic asset allocation do to you? Very simple. It does not need reminders. Automatically, your allocation will be adjusted according to the market. And it will help you to get three things together. Dynamic asset allocation will generate faith in you, because at any bad part of your investments, you have some portion of your wealth into debt, and that gives you comfort that if you need money anytime, you can use that money. It gives you a lot of trust and faith in your journey. Dynamic asset allocation will bring patience to you, because you will see that in bad periods, your returns will be better than your peers, and it will give you discipline. That's more important. Discipline is not doing something regularly. Discipline is always following rules, not the emotions, right? So it gives you a discipline also. Before I end, I'll just give you two analogies, friends, to understand the final concept of asset allocation. Very simple asset allocation. Whenever you will do asset allocation, believe me, if you'll compare the returns of your funds on a year-on-year basis with your peers, with your friends, with your neighbors, your fund will not do better than them, because your part of your money is in debt, right? And when markets will fall, it will do inferior to your friends, those who have kept their money in deposits and fixed deposits. So if markets are rising, your fund will underperform the person who is investing in equities, and when the markets will fall, your fund will underperform compared to your friends who are investing in postal or fixed deposits. So at any year, there will be some people compared to whom your fund will underperform. It means that in a cricketing language, your fund will never be a man of match. But believe me, your fund will always be a man of series. If you increase that period from 1 year to 5 years, you will see that your fund's underperformance is turning into outperformance. And if you increase the duration to 10 years, friends, what will happen? You will beat each and every friend of yours, your peers, your neighbors. Your fund will be the man of series. This is something very interesting we need to understand. Lastly, do you need this fund? Yes, if you are not a good driver. What does it mean? It means that, friends, look at this. My wife learned driving car at a later stage of her life, maybe 33, 35 years or 36 years, I don't remember exactly. And she was never comfortable with gears. And when you don't use gears efficiently, when you have a manual transmission, what happens whenever you drive car now, you have to understand when to slow down, when to change the gear, when to give more power to the wheels, when to give less power to the wheels, when to give more smoothness to the wheels, and when to use the clutch, how to use the clutch and gear together so that you can the best of fuel efficiencies. The finest of drivers in this world never use automatic transmission, friends. They always use manual transmission, because manual transmission gives you the best of result. But for that, you have to understand the flow of the traffic. Not everybody can do. And if you cannot do that, for my wife, what is suitable is automatic transmission car, right? She doesn't have to bother. If I have to slow down, what will happen? And if to increase you have to give higher power, what will happen, right? The person who is not a good driver never get good fuel efficiency. The person, if he wants good fuel efficiency and smoothness of driving, always go for automatic transmission cars. And the future is of automatic transmission cars. Similarly, in investments, because it's difficult to control emotions, it's difficult to regulate behavior. At the end of the day, friends, IQ doesn't help you, characters help you, and dynamic asset allocation keeps you regulated as far as your behavior is concerned. Colonel Saab, thank you very much for this opportunity. I present myself if you have any questions. Thank you very much, sir. Namaskar, Jai Hind. I hope I could do it within the 25 minutes time.
Absolutely. It is great. And can you please remove the share?
Yeah.
Yeah. So it was absolutely great, without any doubt. And the surprising part was you touched upon so many different perspectives, starting from Mahabharata, down to the nitty-gritties of what exactly are dynamic asset allocation fund. And I really liked your man of the match and man of the series part. So that really puts the things in the right perspective. There were lots of questions which came to us, but as your session kept on progressing, most of them got answered. There's only one thing that remains is all dynamic asset allocation funds are not the same. They don't work in the same manner. So what are the key strategies that these funds use to be able to meet their meet their ultimate goal?
Colonel Saab, to be very honest, it's a solution. It's not a strategy, number one. Solution to your needs. So what I will suggest to investors, those who want to explore the possibility of using dynamic asset allocation, to sit with their advisor and first understand what their need is, right? And once they understand their need, their allocation, keeping into view their temperament, then you can decide what kind of dynamic asset allocation you can have. It is because this will have both strategy and tactics both. So what kind of model the fund is following? You may find a dynamic asset allocation funds which gives a lot of power to the fund manager to decide when to shift from equity and debt, or you can find funds where the model is used when to shift funds from equities and that, right? And then you will find funds wherein you will have an upper limit to equity and an upper limit to bonds, right? The upper limit to equities and upper limit to bonds gives you a strategic allocation. And if you make that free, if there is no limit to equity and debt, it can be 100% here, 100% there. That gives more tactical leeway to the fund manager. So keeping all this in view, you can decide that which fund is suitable to you. But let me tell you, sir, the most suitable fund in mutual fund is a fund which gets regular subscriptions from investors, right? Civilizations have come on the banks of perennial rivers, not on the seasonal rivers. That's very important, right? So you have to keep into view the fund house. It's in the case of army, I'll put you, it's not the best of guns which wins the war for you. It's a soldier who wins the war for you. But at sometimes even good soldiers also can't do anything if they don't have bullets. You need bullets for your guns, and bullets is in mutual fund is the money which comes to mutual funds, right? So mutual funds should have a history. Mutual funds should have a strong brand which gets money whatever the market conditions are, and then you can decide which fund is suitable for you.
Thank you very much. Thank you very much for this great disposition, Mr. Krishan. We are really grateful to you. This is a very, very new asset class. Most of the people don't understand what it is. And the way you've taken your presentation through, starting from the analogies, and which you kept on giving throughout, I'm very, very sure people who are here attending this webinar would have greatly benefited from it. Thank you very much.
But at the end, if you give me a moment more, Colonel Saab, with all my experience, whatever I gathered in the last 25, 26 years, I can say one thing: investing is not a financial, mathematical, economical challenge. It's a psychological challenge, right? And believe me, if we know the person least is ourselves, right? We don't know ourselves. We don't know how we are going to react in a given situation. Due to that reason, asset allocation is a panacea of our ills in investments. Thank you very much for this opportunity. Namaskar. Jai.
Yeah, that is why, we had a session today called titled "Win the Investing Game by Winning Over Yourself." So you also said the very same thing, and in the end, what you said about the bullets in mutual fund industry, Mr. Manish was very much agree with that because he's one of the foremost fund managers who's dealing with so many of those bullets.
You have to give me bullets to win the war. Now, without bullets, what you will do?
Yeah, absolutely. So
thank you.
Thank you very much. Thanks a lot.